You have about 60 seconds to decide if you want to hear something you cannot unhear. And I mean that exactly the way I say it. In October of 2007, I walked into a small conference room in Midtown, closed the door behind 12 senior people, and told them the system was about to break in a way their risk models said was impossible. No one in that room wanted to hear it. 18 months later, Bear was gone, Lemon was gone on, money funds broke the buck, the funding plumbing froze, and the people in that room were on the phone with Washington begging for a lifeline. I sat at the head of that table watching it unfold exactly the way I had described it. I am calling that meeting again today, and this time I am leaving the door open. I need you to put your phone face down and listen, because what is building into 2026 is not a normal recession call, and it is not a routine rate debate. It is a refinancing wall colliding with a physical metal market that is no longer deep enough to absorb what is coming. You feel it already, even if you cannot name it. You bought gold, you bought silver, you did the math. You looked at federal debt officially over $35 trillion and on current trajectory pushing toward $39 trillion. You looked at net interest running above $1.1 trillion a year, now competing with defense. You looked at roughly $8 to $9 trillion of Treasury debt that has to be rolled over between now and the end of 2026, not at 0.5%, but at 4 to 5%. You watch central banks buy more than 1,000 tons of gold in a single year, a record since they started tracking. You did everything right. And still your screen is red. Silver down 40% from its high. Gold down double digits from its high. Every rally sold at 3 in the morning on the futures tape. And a quiet voice is asking you if you got it wrong. That voice is the most expensive voice in this business. I have watched it cost people fortunes. So let me ask you directly, do you understand the mechanism that is making your metals look weak while the fiscal math is getting weaker? Because if you do not, you will sell at the precise moment you should be holding. By the end of this video, you will understand the exact mechanism, the historical record that repeats every single time, the 3 structural forces that lock 2026 into place, and the 2 numbers you can watch on any free chart that will tell you when the suppression phase is exhausted. Once you see it, you cannot unsee it. Let me lay out the mechanism with no theory. A shock hits crude. Could be war, could be an embargo, could be a shipping lane. Oil spikes. That spike flows straight into inflation expectations. Rising inflation expectations kill any near-term expectation of Fed cuts. No cuts means the 10-year Treasury stays elevated. Right now, that 10-year is sitting around 4.39%. A high-risk free yield raises the opportunity cost of holding an asset that pays you no coupon and no dividend. Capital rotates into paper. At the same moment, safety flows bid the dollar because the world still funds itself in dollars. The dollar index firms. And because gold and silver are priced in dollars, a firm dollar mechanically pushes their paper price down. 3 headwinds from one cause: higher yield. Stronger dollar, higher opportunity cost, all triggered by the same event that should be bullish for hard assets. That is why your screen is red while headlines scream inflation and geopolitical risk. This is not opinion, this is mechanical. But here is where the story changes completely. That mechanical suppression has an expiration date. I have watched it expire the same way every single time in 42 years. Go back to 1973, OPC embargo, oil quadruples. Gold and silver are hit initially on paper. Then the physical bid overwhelms the paper shorts. Gold eventually goes from $35 an ounce in 1971 when the window closed to $850 by January 1980. A 24-fold increase. Silver goes from about $1.30 to nearly $50. 38-fold, 1979, Iranian Revolution. Same pattern. Flat, then gold up 89% in 12 months, silver from 6 to 50 in 14 months. 2001, towers fall. Gold drifts, then starts a decade-long run from around $250 to over $1,900. A 660% move. Silver from near $4 to nearly $50 by April 2011, over 1,000%. March 2020, initial liquidity panic. Paper silver trades to $11.70 on the COMEX. Paper traders call it dead. Walk into any physical shop that same week and try to buy an ounce for $11. You cannot. Dealers are quoting 25, 30 if they have any at all. Most are flashing out of stock. The paper price and the physical price decouple for weeks. Every single time paper suppresses, physical decouples, premiums explode, inventory vanishes, then paper gaps higher to catch physical. There are 0 exceptions in 50 years. So why is what is coming now different in degree? Because 3 forces have never hit together like this before, and all 3 point to 2026 as the year the math becomes impossible to hide. I will walk you through all 3, and there is a specific morning I want to describe to you later, a Tuesday morning where the quoted screen price still says one number, but the real world refuses to sell you metal at that number at any quantity. When I describe it, you will understand why I keep using the word unthinkable. The first force is the weaponization of the dollar itself. In February 2022, roughly $300 billion of Russian central bank reserves were frozen with a keystroke. That act changed what a reserve asset means. Every finance ministry from Beijing to Riyadh to New Delhi to Brasilia got the message in the same instant. If it can happen to one country, it can happen to any country that one day disagrees with Washington. The rational response was not a press release. It was quiet accumulation of the one reserve that cannot be frozen, seized, or shut off remotely. Physical gold in your own vault. And that is exactly what happened. Over 1,000 tons bought by central banks in 2022, according to World Gold Council data, near record again in 2023, continuing into 2024. China adding month after month for more than 2 years. Poland, Hungary, India, Turkey, Singapore all adding. The people who print the money are buying the thing money was meant to replace. That is not portfolio rebalancing. That is a structural signal. That bid does not care if oil is up or down next week. That bid stays. Stay with me. This next part is critical. The second force is pure arithmetic, and it has a deadline written into the Treasury calendar. Federal debt is over $35 trillion today, 39 on current spending and rates if you extend the curve into late 26. Interest is running about $1.3 trillion a year. $9 trillion has to be refinanced in roughly the next 24 months. $9 trillion of old debt issued at 0, 1.5% has to be rolled into 4 to 5%. Run that math yourself. At 5%, $9 trillion costs $450 billion a year more just in interest than it did at near 0. That incremental cost has to come from somewhere, taxes, cuts, or currency. You cannot raise rates like Volcker did to 20%. Put $39 trillion into a 20% rate, and the interest line alone is larger than the entire federal budget. The arithmetic does not permit it. The only path that has ever worked in history when a government hits this wall is to keep real rates negative for a long time and let inflation slowly shrink the real value of the debt. And when real rates are forced negative for years, gold does not drift. It reprices. Every single time. What does negative real rates mean in plain language? It means your savings account says 4%, but inflation is running 5 or 6, so your purchasing power is shrinking even as your statement goes up. Gold is the mirror image of that shrinkage. When they debase the denominator, the numerator that cannot be printed must rise to keep purchasing power honest. The dollar has already lost more than 90% of its purchasing power since 1913 by the Fed's own price data. This is not conspiracy. This is the published history of every fiat currency. They all drift towards 0 in real terms over long periods. Gold does not. Now the third force, and this one is silver specifically. Silver is the only asset on Earth that is both monetary insurance and an indispensable industrial input at the same time. Solar is the big one everyone underestimates. Last year, solar alone consumed over 200 million ounces. Next generation TOPCon and HJT cells use 30 to 70% more silver per watt. Conservative models put solar demand alone at over 400 million ounces a year by the end of this decade. That is almost half of total current mine supply from one industry. Add electric vehicles that use roughly twice the silver of a combustion car. Add AI data centers, defense electronics, semiconductors, 5G, medical. All of it eats silver in amounts too small to recycle economically, so it is used and gone. Supply is almost completely inelastic. Roughly 70% of silver is a byproduct of copper, lead, and zinc mining. You double the silver price tomorrow, and you do not double silver output because the copper mine in Chile makes decisions based on copper, not silver. A new primary silver mine takes 7 to 12 years from discovery to production. Mine supply has been flat to down for 10 years. And refining is concentrated with roughly 60% of global refining capacity sitting in China, which has been quietly limiting refined exports to feed domestic solar and EV. The result is 5 consecutive years of physical deficit where fabrication demand exceeds mine and recycling supply. The deficits have been bridged by drawing down above ground inventory. You can actually see declining in exchange registered stock reports. When a market lives off inventory, there is a final morning. That morning is what I promised to describe. Let me be blunt with you. The paper market can create infinite claims with a keystroke. The physical market cannot create a single extra ounce without 7 years and $1 billion. Sooner or later, physical reality calls the bluff. Let me give you the 4 phases so you know precisely where you are and why the tape feels like this. Phase 1 is panic, 1 to 4 weeks, forced liquidation, margin calls, everything sold, gold falls, silver falls harder, headlines say the trade is dead. Phase 2 is absorption, months 2 to 3, retail capitulates, media writes obituaries, and strong hands take every ounce sold. They do not buy paper. They take bars in Zurich, Singapore, Dubai, outside the banking system. Phase 3 is structural bid, months 4 to 18. Central banks keep buying. Sovereign funds accumulate. Industrial buyers lock long-term supply direct from miners at premiums to spot. Paper still tries to paint charts, but physical buyers ignore it. Phase 4 is new all-time highs and then a repricing where the old price stops mattering. Month 12 onward, public participation, FOMO, and the people who sold in phase 1 buy back at premium from the people who absorbed in phase 2. Where are we right now? We are in late phase 2 transitioning to phase 3. That is why conviction feels heaviest right here. That is designed. That is how the transfer loads, write this down. 2 indicators tell you when phase 2 is ending, not war headlines, not CPI, not a Fed speech. First, the dollar index. When DXY breaks below 97 and holds for 3 sessions, the currency headwind is exhausted. Second, the 10-year Treasury yield. When 10-year falls below 3.55% and holds, the opportunity cost headwind is exhausted and real yields have turned negative enough to force capital out of paper. Watch the dollar. Watch the yield. Everything else is noise intended to shake you out. Now that morning I promised, imagine autumn 2026. The refinancing wall I mentioned is hitting headlines because interest expense is now visibly crowding out everything else. The Treasury auction that week is weak. The Fed, cornered by the debt service math, signals a funding facility that is obviously debt monetization by another name. The dollar index drops hard. At 7 in the morning Eastern, retail platforms crash because everyone is trying to buy physical gold and silver at once. By 8, every major dealer website in North America shows 2 words in red, out of stock. You drive to a local coin shop. There is a line. The owner steps out and says his wholesale desk has suspended sales indefinitely because he cannot replace inventory at any price his distributor will quote. You go back home and open a brokerage app to buy a well-known silver trust. Trading is halted because the custodian cannot source bars to create new shares. On the COMEX, delivery notices spike, registered inventory drops to near zero, and the exchange board discusses cash settlement because there is not enough metal to deliver. The ticker on TV still says $30 for silver, $3,000 for gold, whatever number makes headlines that day in the real market of bars and coins. People are offering double, triple that number in private deals and finding no sellers. That is what a physical stock out looks like. It does not announce itself a year in advance. It happens in 72 hours. I have watched a light version of this in 2020 and again in early 2021. Physical premiums at 15, It's not our job. $20 over paper, that was the preview, not the film. Let me give you the scale so you stop thinking in percentages and start thinking in physics. Total investable above ground physical silver bullion, not jewelry, not flatware, bullion is roughly 2 to 2.5 billion ounces. At $30, that pile is worth $60 to $75 billion. That is not a market in institutional terms. That is a rounding error. Global pension funds alone sit on more than 50 trillion. A 1/10 of 1% allocation from that pool is $50 billion. Nearly the entire physical pile at today's price. 1% would be 500 billion. The pile cannot absorb that. The door cannot get wider. The door slams shut in price gaps until that flow is turned away. In 1979, two brothers from Texas took roughly 100 to 200 million ounces off the market, and silver ran from 6 to 50 in 14 months. Now imagine not two brothers, but dozens of sovereign treasuries and thousands of industrial supply chain managers all told their risk committee that they need physical insurance. Do you see it now? Do you see why the question is not will gold go to some bigger headline number? The question is whether you will be able to buy it at any quoted price when everyone figures out the same math. That brings me to what happens to people. There are two types of holders watching this right now. Type 1 sees silver down 40% and concludes the thesis was broken. They feel the account pain. They read the commentary. They sell. They put proceeds back into a bank product that pays less than true inflation, and they feel relief for about 48 hours. Type 2 sees the same drawdown, then looks at 39 trillion in debt, 1.3 trillion in interest, 9 trillion to roll by end of 2026, 5 years of physical deficit, 60% refining concentration, 200 million ounces into solar growing toward 400 million, and a dollar index that cannot stay elevated once real rates crack. They see mechanical suppression and structural setup, and they accumulate quietly while it is uncomfortable. I have watched both types for 4 decades. At every major bottom, Type 1 funds Type 2, every single time. Could gold trade at $10,000 an ounce? Let me answer that without hype, only arithmetic. 10,000 is 5 times from 2,000. In the 1970s, gold went 24 times. In 2008 to 2011, roughly tripled off a crisis low, while debt was a fraction of today's load. If you monetize 9 trillion at 4 to 5% and drive real rates back deeply negative for several years to make the debt service survivable, the repricing is not a straight line. It gaps. I am not giving you a prediction. I am giving you the physics of what happens when a fixed stock meets a flow that must go somewhere, and the only place that flow can survive is outside paper. Think back to where we started, 2007, closed room, no one listened. 18 months later, the plumbing stopped. Tonight I left the door open. I showed you the suppression mechanism, the 50-year pattern, the 3 forces converging into 2026, the 4 phases, the 2 tripwires, the Tuesday morning where physical disappears, and the simple math that makes a repricing inevitable. What you do with that is your decision. It always was. But you cannot unsee this now. You cannot erase the refinancing calendar. You cannot erase the 5-year deficit. You cannot erase the sight of dealers going out of stock. You will either watch the 2 numbers I gave you with discipline, dollar index below 97, 10-year below 3.5 and let the transfer work for you, or you will let the noise shake you out and watch the repricing from the outside. Insurance does not pay while the building is burning. It pays after the smoke clears. Hold the line until the smoke clears.